Hi, my name is Gift Constable, and this is the little pre-lecture focused on the income statement and a few financial definitions. It's a sort of a prelude to the financial fluency for product leaders class that I teach on Maven. The purpose of the class is not to make anyone into a CFO or an accountant, but rather to help product managers, designers, engineers who want to build up their financial fluency, their sort of corporate finance acumen, so that they can be more successful, make it to the C-suite and be successful there. That's the purpose. I myself am a product leader as opposed to a CFO, and that's the orientation of the class. One of the things that I've been doing with the class is pulling out bits of lecture from the live classes so that we could focus more on interactivity while we're together. And so I'm going to be releasing some little videos like this, which I'm sharing not just with the class, but actually with everybody. So with that little sort of preview, let's just dive right into the material. I'm going to share my screen and a few slides, and let's blast through a few things. All right, so two expressions that you just might hear of before we get to the income statement, I just want to touch on quickly. One is this word GAAP that you might hear. GAAP stands for Generally Accepted Accounting Principles. All this is what are the standards and the rules for how accounting is done in the United States. So that's what GAAP is. The second is accrual versus cash accounting. Businesses will manage their books in one of two ways. And the easiest way to actually explain this is to give an example. So let's pretend that you're in let's say a SaaS business and people subscribe to your product for $100 a month. And they're going to pay upfront for the first year. So they're going to pay you $1,200. So how would you account for this with accrual versus cash accounting? What accrual accounting does is it tries to match up the time with when income or an expense goes on your books with when the activity is done. The product is consumed, the expenses is handled, etc. While cash accounting basically says, let's record things when the cash moves. Okay, so in our case, we've been paid $1,200 up front, but under accrual accounting, we take $100 for each month that the product is used over the course of the subscription. It doesn't matter whether someone pays us up front or in the middle or at the end. It has nothing to do with the timing of when the actual cash moves. It simply is that there's an obligation. The customer's made a contractual obligation to pay $100 a month, and they're going to be using it over 12 months. So we spread it out over 12 months. With cash accounting, right, they paid us the $1,200 up front. So when that money hits our books, it goes on our books. When money hits our bank account, rather. So, and the same thing goes, like if we make a payment and that we have an expense, when that expense happens, that's when it would go on our books. You know, if they waited 6 months to pay us, that's when it would hit. Now, for 99% of you who are watching this video, your business is most likely an accrual-based business. It's usually only small and like small family-owned businesses that run on a cash basis. If you're venture capital backed, owned by a private equity firm, or certainly if you're a publicly traded company, you are using accrual-based accounting. But just wanted to make sure people understood those terms because they get bandied around. The last phrase that you might have heard of is called bookings. What are bookings? Bookings are essentially the contractual value that you've sold. And so in the first case, while we might be recognizing our revenue over 12 months for $100 each month, we did sell a year contract at the beginning. So our bookings is going to be $1,200 at the start. If we sold a 3-year contract, it would be $3,600 as opposed to $1,200. This is a useful term because while it is true that, you know, a 3-year contract might end early and things could happen, it gives tracking bookings gives a company a real clue as to the amount of sales that it has going into the future, and so the amount of contractual value that it is managing to land each month, each quarter, each year. Now let's talk about the income statement. This is by far where you as a product person, a product leader, are going to be spending the most time. There's elements of cash flow that you might be paying attention to. There's elements of what's happening in your balance sheet with assets and debt that you might pay attention to, with how projects get capitalized. But you don't really need to be deeply steeped in how a cash flow statement works and how a balance sheet actually works. Not here to be an accountant, and the class is not here to teach you how to value stocks and be a publicly traded company investor. But we are going to talk about use a publicly traded company to talk about the income statement. All right, so there's a whole bunch of terms that will show up on an income statement that you need to know. And the easiest way to explain this is again with an example. And so what I've done is I've chosen Salesforce.com's latest income statement. Their fiscal year ends January 31st. There probably is a 2024 one that's out right now, but this is from last year. So this is 2023, 22, and 21. The first section is revenues, and this is probably the one that everyone understands the best. Revenues is the value of the sales that you have for the products and services that your company produces. It can be called sales. It can be called revenue. I think in the UK it's called turnover. So it has a bunch of different names, but that's what it essentially is. You make a product, you deliver a service, whatever it is, you charge for it. The money that comes in is your revenue. Now, again, that might be spread out over time, but whatever sort of amount that you've decided to recognize for that particular month, that's what shows up, or in this case, this particular year. You always want to note what the sort of unit is. So all the numbers you see here are in millions. So here you have 29 billion in subscription and support. Now, when we look at this, we see that Salesforce.com broke out subscription and support and professional services and other. Why do you think they did that? They don't actually have to. A lot of publicly traded companies don't do that. They just show a revenues line. They did this because they're trying to manage the optics of their business. They want to make it very clear to everybody that 93% of their business is from software subscription and support, and only 7% coming from professional services. Why does that matter? Well, software tends to be a much more profitable business than services, or at least it has the option of being more profitable. They may decide to run their business at a loss, but from a gross margin perspective, which we'll talk about in a second, it's more profitable. So what they're trying to do is say, look, like we're primarily a software company, not a services business. And they're proactively breaking that out so that you could see where that's coming from. Now, the other thing to note about revenues is you can get these two words that are used, gross revenue versus net revenue. An example of what this means, let's take a marketplace. Let's take Amazon's third-party marketplace, for example. And so third party decides that they're going to sell, let's say, a phone on the Amazon marketplace for $1,000. And Amazon takes, and I'm just going to guess a number here, let's say they take 10%, so they're going to get $100. If Amazon decided to take and book that full $1,000 as revenue, that would be considered gross. If they only count their commission, they're going to, so their 10%, they're going to take net. A lot of distributors have to think about this. Think about Airbnb. Are they going to account for the total value of a rental, or are they going to take the commission that was paid to them for the rental? So a lot of companies have to think about which number do they choose. And so that's what gross versus net means for revenue. Let's get into the expenses side of things now. So you have this section that Salesforce.com has called cost of revenues. And this actually comes also in a few different names. It could be called cost of goods sold, COGS. You might have heard that acronym used, COGS. Manufacturing companies call this cost of goods sold. But here, they call it cost of revenues. Confusingly, it could also be called cost of sales. Oftentimes, if this top section is called sales, they'll call this first bundle of expenses cost of sales. If it's a consulting company, they have services revenue, they might call it cost of services. So regardless of the name, what is this bundle of expenses meant to be? This is the cost to produce the product or service that you're getting your revenue from. Okay, so if you are selling services, If you're selling consulting time, it would be the cost of the consultants who deliver the service that allow you to earn that revenue. If you're making a car, it's going to be the factory and the materials and the labor that goes into making the car. Where this can be confusing, and where you have to avoid the confusion, is that it is not actually the cost to sell and market the product. That goes down on your operating expenses. So even though sometimes it could be called cost of sales, it's not about selling expenses at all. This is about the cost to produce the product or service, okay? That allows you to earn your revenue. Now, when you subtract this cost of goods sold or cost of revenues from your revenue, you get what's called your gross profit, right? And the percentage of your gross profit over your revenue is your gross margin, right? So this is a key metric that companies use because they're basically saying, look, it costs us this much just to make the product, regardless of like how else we're running our company. So how much money is left over for sales, for marketing, for R&D, for all these other portions of our business? Companies that have very high gross margins, that are highly profitable from a gross margin perspective, tend to be valued a little bit better because they have more flexibility. They can invest more in the other parts of their business. It doesn't necessarily mean that you're a better business than a low gross margin business. Your valuation multiples tend to be higher, but whether you're a successful business or a struggling one has to do with a lot of other factors. There's a lot of very big, very successful businesses that have lower gross margins because that's just the industry that they've chosen. With software, most of the expenses that go into software products actually don't go up here in the cost of revenues section. This may change over time. I actually think it probably should, but right now, what really goes into the cost of revenue section is mostly the infrastructure, especially now that everything is sort of SaaS-based, everything's hosted. It's the infrastructure that allows you to host your software product. So think about it. If your company hosts its software product on AWS or on Azure or Google Cloud, wherever it might be, it's that cost that ends up being in this cost of revenues section. And usually there's a portion of your customer support or customer success that your accountants and your CFO have decided we're going to allocate this much of your customer success or support to saying like this is required to maintain the revenue we have. And so they'll take a percentage of that cost and they'll put it under here. But amusingly, or oddly, at least to me, most of the product and engineering team actually goes down in the operating expenses section of things, even if a lot of our time is tied to maintaining our products as opposed to doing new innovation. But that's one of the quirks about the technology industry. All right, so oh, and one thing I wanted to note here about Salesforce that's interesting is, again, they've broken out their software subscription and their professional services. And if you actually look at the gross margins of the two, right, they have the cost of revenues on their software is quite low relative to the revenues that they have, right? It's 5 billion over 29 billion, almost 6 billion over 29 billion. However, the cost of revenue for their services, the cost of services compared to the revenue for services is actually higher than the revenue. So they're spending more on just to have the labor and the capability to offer professional services than they're getting in revenue. Now, they do that intentionally because that's their choice as a predominantly software company. But it's just another indicator about how the margins are radically different between software and services, the gross margins, that is. When it comes to operating margins, which is down at the bottom, we'll get to that. That really can vary dramatically based on the business. So we talked about gross profit. We talked about what gross margin is. Now, the rest of the expenses, the bulk of the rest of the expenses tied to the operations of the business fall into the operating expenses line of things. And so R&D. Now, R&D is sort of a funny term, research and development. It doesn't just, as I sort of have mentioned, it doesn't just stand for the cutting edge innovation work that the name implies. Really, what's going into here is the entire product engineering design, product capability. And so that's the expenses within a software company that show up under R&D. Marketing sales is pretty self-explanatory. Sometimes these are broken out, sometimes they're not. Companies have a lot of optionality in terms of how detailed they break out subcategories of these things. Sometimes you see marketing, sales, and G&A sort of tucked in together into one line item. Salesforce has decided to break them out separately here. So what goes into general and administrative? Well, that could be things like your office managers, let's say your lawyers. It's sort of other expenses tied to the business that aren't tied to R&D and marketing and sales. They also have this line here that you don't always see called restructuring. And why do you think Salesforce has put a restructuring line here? Well, once again, it's about managing the optics for possible investors, for analysts who are looking at the business. What they're trying to do is get people looking at the business to see this number. It's almost $1 billion of a restructuring charge in the fiscal year 2023 and back it out and say, we know we incurred this expenses. We know this made our bottom line look a little bit worse. But as you're like looking at our business and thinking about the ratios of how profitable we are, like make this number go away because it's a one-time thing. It's not a regular thing. And so they've added this line and they said, look, it was zero, and now it's hit us and it's 1 year. Now, some companies try to play games with this and they'll have multiple restructuring charges, on multiple years, and analysts get smart about that. And they're like, no, we're not going to back out that number. That's clearly part of your cost of doing business. But in this case, this is what they're hoping for. And that's probably how a lot of analysts would treat it. So you take your operating expenses and you get your operating income. They call it income from operations. So again, the wording can vary when it comes to these things. And your operating income divided by your revenue is your operating profit. Okay. Now, below the operating profit, they also have this line, gains and losses on strategic investments. So they might have made some investments in other companies, and possibly they made an investment in a company they were thinking about buying. They didn't have a majority stake. Maybe they got out of that position that they had and had a return or had a loss. Like those non-operating things might show up down here. You get taxes and you get your net income. Net income actually matters much more for publicly traded companies because that's the number that's used when people calculate your earnings per share. That's the net income over the total shares outstanding. But for a lot of privately owned companies, whether they're large or small, you're often paying attention to a different number as opposed to net income. And let's talk about what that number is. That number is called EBITDA. It doesn't show up here on Salesforce's income statement. What it stands for, this funny acronym, is earnings before interest, taxes, depreciation, and amortization. What are those pieces? Okay, so earnings is your profitability after your cost of revenues and after your operating expenses. And they said, we're not going to account for any interest, income, or expenses that we've got. So if they have a lot of debt on their books and they're paying interest on that debt, they say, we're not going to count that, right? If they've made some investments and they're getting interest income, they're not going to count that. They're saying that's not part of the operations of our business. Those are capital decisions that you've made. Okay. Taxes, people can play a lot of games with taxes. And so they say, we're going to disregard. I mean, taxes are important in terms of the cash position of the company, but they're not important as we're thinking about the core profitability of it. So they back that out. Then you have depreciation and amortization. What are those two things? Depreciation is when you take, let's say you build a factory or something much smaller, you buy a computer that has a lifespan to it, and you spread out the cost of that expense over the period of time. You're essentially burning down the expense of that asset over a period of time. For depreciation is the word we use when it's something tangible. Amortization is the word that's used when you're spreading out the expense over a period of time, or for something that is intangible. It doesn't have to be an expense. Also, it could be spreading out an asset. But like something intangible, for example, could be brand value. You acquire a company, you pay a premium for that company. A certain portion of that premium is allocated to the brand value that company has, as opposed to profitability or staff or intellectual property or things like that. Actually, IP is an example of something that is also intangible. It's not physical as well. And so when you're spreading out and burning down sort of the expenses tied to intangible things, it's called amortization. Okay. And so, one of the reasons why it's backed out here for depreciation is the expense already has been made, right? From an accounting perspective, we're spreading it out, but the expense already been made. And with amortization, it's something that's intangible. And so what investors are trying to do, what owners are trying to do is say, give me a number that's a reasonable proxy for the operating profitability of this business, right? Um, there's also another term that I'm not going to get into here, but you can go look it up on the internet, called free cash flow, that a lot of investors use as they're trying to understand how much cash can this business throw off. But a lot of the time, you as a product leader will be looking at this EBITDA number and thinking about it. What's interesting about this EBITDA number as well is it tends to be this key figure that the private equity world, and private equity is the majority of buyers of companies and owners of companies these days. It's the key thing that they will use to value companies is going to be multiples on EBITDA. So that number matters. Now, when you're looking at an income statement, there's two ways you want to look at it. You want to look at it vertically across a time slice. So if we look at our fiscal year 2023 for Salesforce, we want to see, okay, what's our revenue? What's our gross margin, our percentage of gross profit over revenue? And as you noted before, we can break out, what's the difference between the gross margin of the subscription and support business versus the gross margin of the professional services business. Right. And then you get down and you say, okay, what's the percentage of that we're spending on R&D over revenue? In other words, like for every dollar of revenue that we get, what percentage goes to our R&D? What percentage goes to sales and marketing? What percentage goes to G&A? Right. These are useful things to track. When you're inside your company, you will ideally get more granular data than this. So you might be seeing, what are we spending on different kinds of marketing, or what are we spending on different elements of our sales capability to help you really understand percentage allocations. R&D might be the same thing. What's the percentage on design versus product management versus engineering versus, data versus AI, so you might end up going quite deep, but those ratios are very useful to help you understand the allocation of money and spend in a business, right? So you look vertically, but then you also want to look horizontally. And just to state the obvious, what you're looking horizontally to see the trending. Is it changing over time? Is our revenue year over year growing, staying flat, or shrinking? Is our gross margin getting better or getting worse, right? Or staying the same? Is our allocation of where we're spending our money on R&D versus sales versus marketing, is that changing over time? It helps tell the story of the business, right? So look both vertically and horizontally. Now, as I mentioned to you, right, there's the balance sheet and there is going to be the cash flow statement. You're going to spend less time on those as a product person. However, it might be important for you as a product person to understand, how does cash flow work in my business? What is the timing of when we get paid versus when we're paying out things? And is that something that I, as a product leader, want to help? Is that something that we should be, actually trying to assist with, control, facilitate, block, whatever it might be? So you want to be aware of how cash works and the timing of cash, and just be aware by talking to your CFO and CEO, is that something that's important for us to pay attention to and have on our radar as we think about our portfolio of work. The other thing that's relevant about the balance sheet, there's two things to be aware of about the balance sheet. One is just always good to be aware of how much debt your business is carrying. Ideally, you also know how much cash your business has as well, right? What does cash mean? Cash gives you the ability to invest in growth. It gives you the ability to survive hard times. If you are losing money, let's say you're a venture capital based business and you're intentionally losing money because you're going for growth, it tells you what your runway is. When is the sky going to fall? When it comes to debt, we're all in software. A lot of us are related to software products we're taking in this class. We understand this term technical debt. A little bit of financial debt can be very useful. It can fuel growth. It can give flexibility to a company. A lot can be really burdensome. Right? It can saddle your business with interest expense. And if you, go through a hard time, if you have a bad quarter and you miss a debt payment, you could lose your business. They could take it from you, right? And so, and if you're carrying a lot of debt and the business is thinking about exiting, the debt holders take their money out first before anyone else does, right? It goes debt holders, then preferred shareholders, and then common shareholders. Um, and so, as an employee, sometimes you're last in line if a business gets sold. And then finally, there's this concept you need to understand around how software projects actually get the expenses of that get spread out over time. It used to be that companies really had to think about whether they capitalize their project and then spread out the expenses over a certain sort of lifespan of the project. So let's just say that they spend $1 million in a couple, a few months, and they might decide that they're going to capitalize that, put that on their balance sheet, and then like burn down that cost over a 5-year period. A lot of software companies didn't like to do that. A lot of bigger companies did, but a lot of software companies didn't like to do that because they felt like they had the profitability to just take that expense, get it out of the way. And then if the project didn't work out, they didn't have this, if it didn't achieve the revenue it wanted or it got killed or whatever, they didn't have this sort of drag, this anchor of continual expenses of something that wasn't really, flying anymore on their books. So that used to be more of a decision. However, just in the last few months, the US government has come out and said that the way new software development needs to be expensed needs to change. It needs to be spread out over 5 years, a 60-month time period. The interesting thing about that, as I read that documentation, is that it's really focused on new software development. So I think there's an interesting conversation for product people to have, product leaders to have with your chief financial officer, whoever's in charge of finance for your business, to help them understand the nature of the software work, the product work that you're doing, because some amount of that work is going to be new development, some is going to be maintenance, more incremental work, there's tech debt management that you're going to be doing, replatforming that you could be doing. The more your sort of CFO or whoever's in charge of accounting understands the nature of your work, the sort of the portfolio of work that your product organization is doing, again, that means product management, engineering, and design, the better choices that they could make in terms of how do we want to treat or how do we want to handle the expenses of our software projects. So that's really up to them to decide on the timing. But a lot of folks in the finance organization don't understand how the sausage is made on the product side of things. And so I think you have a role to play to help educate them, and then they can make a more informed decision. So that sort of wraps up key points that I want to get across to folks around the income statement and just a few things that are tied to cash and balance sheet issues as well. So with that said, I'm going to let you go. For those of you who are joining the next cohort of the class on Maven, Financial Fluency for Product Leaders, I look forward to seeing you.